The market is absolutely euphoric about the expected rate cuts coming out of the Fed in about 9 days' time. Unemployment data is pointing towards a bigger cut. Revisions are expected this week as well, which are really interesting because they'll be going back 12 months up to March, and those could have a huge impact whether we're seeing a jumbo cut or just a normal Fed rate cut. And on top of things, we're getting inflation data this week. So lots going on the macro side, lots of going on in the data side. And I've invited a fantastic guest to sort of discuss this. His name's Peter Tchir. He's the head of macro strategy over at Academy Securities, and I'm really looking forward to getting his insights and trying to make sense of it. Why are markets rallying? Gold is at an all-time high as well. I forgot to mention that here. And should we fight the Fed? He just gave me that line here. Should we fight the Fed? Should we let things run? And should we just join the party? So lots to discuss here in a very short time frame. But before I switch over to my guest, hit that like and subscribe button. Helps us out tremendously. It's a free way to support our channel. Much appreciate that. Now, Peter, it is great to welcome you on the program. Thanks so much for joining us.
Thanks a lot for having me.
Yeah, Peter, really looking forward to this. We just had a chance to chat off camera here for a minute. Lots to discuss. But since it's your first time on the program, I'd love to see where your head is at and maybe just get an understanding of how you rank the economy and the financial markets right now. What do you make of them?
Yeah, and just quickly, because I think it'll help. By way of background, I was much more a fixed income and credit trader. I traded the credit derivative indices throughout the financial crisis. So that's kind of my background, is more from a trading and credit perspective as I kind of morphed into macro. And I do get to work with a group of retired generals and admirals at Academy Securities, which provide a lot of geopolitical insight. But right now, I'm a little bit worried about where we stand. I think the tariff data or the tariff impact is only going to start showing up, months down the road. I think maybe we're getting hints of that. So I think a lot of people have been celebrating, oh, tariffs didn't have an impact, and it's very premature. There haven't been a whole lot of tariff payments. Inventory hasn't rolled over. I think the flip-floppy nature or the sometimes erratic nature of our policies, I think, is keeping businesses handcuffed. I think that's been showing up in the data and will continue to show up in the data. And the thing that to me has really been driving this economy is the investment in AI, data centers, chips, and electricity production. And you're starting to get a sense, at least I am, that maybe we get a bit of a slowdown there. So I think those things are all weighing on the economy. I think they're all a bit problematic. And I don't think rate cuts are just going to be enough to keep markets as high as they are.
Yeah, exactly. Like $6,500 in the S&P. We've all probably listened very intently to the NVIDIA earnings calls here, or in the earnings report that just came out about 10 days ago or so it was, and the slowdown in data centers. Maybe we stay on that topic just for a second, just the AI built out. Maybe if you want to get a bit more granular, because the Mac 7 are dominated by AI, obviously. So like if any slowdown comes in the S&P 500, it is from that side.
Yeah, and how I would look at it is I was a little bit surprised by just how much AI spending occurred, Q1, Q2, and even coming into Q3. And part of that is when I go back and talk to our corporations, what I realized is a lot were on hold for a lot of things. There's this kind of on hold mentality towards, hiring or firing people, right? People are reluctant to do much. I think in terms of investing big time in property and plant and equipment, again, that's a little bit on hold because the rules are uncertain. But I think what was unleashed was AI was the story of the day, right? People were really getting into it. B, I think people decided, well, whether the economy is good or bad, it would be good to be efficient, so I'm going to invest in AI. And now here we are 6 months down the road, and you're hearing more snippets of conversations about we invested and we're not sure what we got. Yeah, this really seemed cool, but how is it actually driving our business going forward? So I think we're now at that stage where we're questioning it. And to me, it reminds me a little bit of the broadband and fiber build out in the 2000s, right? Fiber was going to dominate. All the companies involved with fiber were great, and we overbuilt.
Yeah, sorry, there's just a bit of lag here on the line here, Peter. But it really seems like we're paying more attention to valuations a little bit as well. Things are still honky dory, of course, on the earnings side. Still growing, but as you said, there are massive headwinds, and maybe that's a good segue to discuss employment as well. We're seeing more layoffs across the board. Maybe you can, run us through what you're seeing as well. Of course, the employment data last week was a disaster. Massive underperformance from the expected forecast here. Like, what are you seeing?
So I'm seeing that I think the data has still been overstated, even with some of the revisions. So I believe we're in a no hire, no fire economy for a lot of large corporations. I do think we're seeing entry level jobs, particularly that would typically go to college grads, be taken over by AI. People are saying, well, maybe we'll just hire 2 analysts instead of 4, and hopefully those 2 can deal with the AI spend that we've done. And you're seeing kind of, unemployment for recent college grads tick up. So that's, I think, who's bearing the brunt of this. I think you're seeing a bit of a slowdown in consumer spending. You're seeing a bit of a slowdown in restaurants. My favorite data point is the quits rate in JOLTS. And the reason I like the quits rate so much is, to me, it's kind of crowdsourced, lower income, earners, right? Those are the people who wake up one day and say, hey, you know what? I can get a job better elsewhere, or maybe I want to take a couple weeks off and then I'll get a job. So they quit. That's very low right now. And the other thing I think the Fed's been, the BLS has been doing wrong is the birth death model, right? They see this, and what it's linked to, and this will get a little bit wonky, but I think it's really important. People apply for an EIN, or an employment identification number, when they set up a new company. The birth death model looks at that and says, oh, these applications represent someone starting a company, and maybe it applies to one person, maybe they're hiring a couple people. And I think what's happened with the gig economy, when you get these increases in EIN, it's actually a worrisome signal for the economy. It means people are nervous about their jobs and decide, well, maybe I want to drive Uber, so I might as well set up an EIN if I want to drive Uber. I think you also get some people who are getting more sophisticated and saying, well, I'm going to separate my Uber from my Lyft, or my Uber versus my Uber Eats. So they're getting multiple EINs. And so those applications show up as these big job gains in the birth death model. And I think it's actually a warning sign that people are so nervous about their jobs, they're starting to look to the gig economy. And to me, that is very well supported by, I like the law school applications. I think we're at a post-GFC high. And to me, that's another area where you're sitting there, you're not sure you're going to get a job out of college. Law school seems like a pretty decent way to spend your next 3 years. So I think the economic data has still been overstated. It's going down weekly. And now we might start getting the firing as people are realizing, hey, some of these tariff policies are here to stay, and it's really hurting small and mid-sized companies. And that's the last bit I'll add is, I think the small and mid-sized companies, their data takes a while to make it into the data we see. I think we're good at collecting data from large companies, not so much from small and mid-sized. They're the ones really feeling the brunt of tariffs. So I think the data is going to get worse. I think the Fed's way behind the curve. They should have been cutting already.
You bring up the EIN data, which is really interesting, because I had a conversation with somebody this week about that, and I wasn't aware of it, and I haven't really fact-checked it. But he told me that when somebody creates an EIN, like a gig economy company or job, that, I don't know, even just to manage their OnlyFans, just trying to be funny here a little bit, but only just to do that, the BLS automatically assumes that 7 people might get hired based on that. Is that's correct? Like, and how does that make sense?
I'm not sure if it's still 7 people. I don't know what they currently do. But yeah, they really did think, and at one time it was true, right? Maybe you set up a bakery. So you're going to have yourself, maybe a couple people baking. You're going to have some number of employees. And that's where I think that's this huge overstatement. And that's why we get these big downward revisions, is they really still treat EINs as though they're small businesses. And I think it's much more a smart way for people to do the gig economy, including OnlyFans. And so people are doing that. And that's where you get this misread. And that's why you're getting these big adjustments. Even this past month, the payroll was 99,000 of based on this birth death model that comes from those EIN applications. You really think that many new businesses started? And it was higher the last 2 months. So I think it's a mistake. And that's one of the things. I think the BLS has been very slow to realize things and change. And we are running, I'm a computer science major by background. We're really running on garbage in, garbage out. If you don't have good data coming into you as an analyst or a business person, how do you possibly make good decisions? I think we don't spend enough time scrubbing the data and saying, hey, does this data make sense or not? Unfortunately for me, I was on a flight back from London on 3rd of July, and I thought the June employment data was going to be really weak. I thought it was going to be awful. Turns out on July 3rd on my flight, employment data was great, and I was completely wrong. 2 months later, they're saying they actually lost jobs in June, which was what I thought all along. So it's hard for us to deal with this kind of bad data. And I don't mean bad in a sense of, it's good or bad for the economy. I just mean it's poorly done. It's not well calculated.
Yeah, it's 2 follow-up questions here for you, Peter. A, of course, we're expecting revisions tomorrow, September 9th. Run us a quick through your expectations. I sort of almost like a rhetorical question here, Peter, but what are your expectations?
I haven't done the work myself. But some of the people I talk to do a lot of work. I think the number is going to be between 500,000 and 800,000 downward revisions. And a lot of that is going to come from this overstatement from the birth death model. I think they just realize they create all these new jobs because that's where the EIN applications go. And then when they start actually getting the payroll stubs and all these other things, guess what? It wasn't a creation, right? There may have been no jobs. If you still have your job and you apply for an EIN because you might want to drive Uber on the side, that's not a new job. That's not 7 new jobs. Certainly, it's 0. And so that's why I think you're going to get such big negative revisions, because the BLS has not spent the time or figured out how to deal with the gig economy has done to these EIN applications.
Do you think that's a leadership problem? Because the head of the BLS was just recently fired by President Trump, and we're still waiting for the appointment of EJ Antony here. So is that a leadership problem, or where do you see the problem then?
Whew, it's a great question because I think the other thing to me has been that I harp on a lot is the survey response rate used to be above 60% on the initial survey, and it's down to 30%. And when you look at any sort of market testing, right? If you get a very low response rate, was there a bias to those responses? Maybe the people who are hiring put in their responses very quickly because they are happy that they're hiring. And maybe the people who aren't hiring or firing people don't put in the responses. So I'm not sure why we weren't examining these things more closely. Why we weren't saying in this day and age of, so much data so readily available, what would be a good way to get this done better? So I feel they were in a bit of a rut. Part of it is I do believe it takes them time. They've got a lot of rules and procedures that any changes they want to make has to go kind of through various committees. And I think part of that is to ensure that there is a procedure that's followed that can't be changed willy-nilly, so you don't get good jobs data or bad data depending on the political view. But I think this could use a real overhaul. To me, I talked about this when Doge was announced. This was the exact sort of thing Doge, in theory, could be good at, right? A bunch of computer science. Let's figure out how we should calculate the jobs data. Look at CPI. So many of us turn to Trueflation now rather than the BLS data because we think things like Trueflation are a more accurate measure. So in this world where we just have so much instant access to data, we have I think the two mistakes that have been made, we haven't thought about how we're getting our data, how we process it, and we also do a lot of adjustments, seasonal adjustments, annual adjustments at the BLS. And why not just send us the raw data and let the market kind of crowdsource, hey, these people seem good at figuring out what the seasonal adjustment should be or not. So I would love an overhaul and a rethink of this because I do feel we're stuck in kind of what might have worked 20 years ago just doesn't fully take advantage of the data and access and computing power we have today.
So Peter, it's like we've been reading about mistrust or eroding trust in the U.S. data in general, not just employment data. What do you make of that? Is it just is it being politicized, or is there actually like a lack of quality data? Is the data being manipulated?
I do not believe it's being politicized. I think it's, how it's collected, we've been in this rut. We aren't willing to make a lot of these changes that I think should be made. I'll talk about owner's equivalent rent as yet another thing. I do a lot in this business. I think I'm reasonably smart. I barely understand what owner's equivalent rent is, yet it's this huge important calculation, right? Why aren't we using something like Zillow that measures real-time rents? The Cleveland Fed has actually produced their own real-time rent. It would give us much, much better data. I think the lag effect of owner's equivalent rent was part of what caused the transitory beliefs back when they missed hiking. And I think it's a problem now because it's overstating what's going on. I do think a shakeup at the top where we say, hey, we have all these disparate entities. We've got the Fed, we've got Liberty Street, we've got all these great research people, we've got BLS people. Let's unharness them, let's unleash them and say, if we could start over, how would you do this? And see what we can pass through. Because I suspect if people kind of started from scratch and said, let's think out of the box, let's throw out how we've been calculating or how we've been collecting this data for years or decades, and how would we do it now given all the tools available, we would have much, much better data. But without it, it's, we're in a society where when data comes and gets, mixed up all over the place, gets revised, there is going to be, accusations of politicization. Some people will believe it. I don't think that's true, but it does make it hard to make decisions. If you can't get consistency within the data, you don't believe the data. If ADP, for example, is telling you one thing different than the, how do you make decisions? So I think it would be a high priority to do this. At the same time, if we do go politicized, we start looking like China. I cannot tell you what the Chinese data is at any given time because I don't believe any of it's true. So I don't want that to become what happens to the US. I think we have an opportunity to really fix it, make it incredibly useful, real time, and accurate, so we don't have to turn to things like Trueflation to look for, where inflation data is. Again, I think that was one big thing even in the presidential race. Everyone's like, oh, inflation's tamed according to official data. No one who's living in the real world felt that inflation was tamed, right? You go to the grocery store and your price of meat or whatever you're eating is going up every single day. It didn't reflect, and I think political mistakes were made. I think, policy mistakes have been made based on not having that accurate data. And there's just so much opportunity this day and age to get that, process it correctly, put out there, let it be evaluated. And I think we'd be much better off and you'd have much better decisions.
Yeah, it is interesting because the Fed is basing their decisions on the data. They're data dependent. They're telling us, right? And you brought up Trueflation. Well, Trueflation is telling us inflation is 1.98% today, but the BLS reports 2.7%, right? So
Right.
how does that sort of fit together? It's like like, how difficult? And the reason we're asking, that's why we're doing this exercise, Peter, is to really understand what is moving markets right now and to what will influence the Fed decision moving forward here in about 8 days' time. Um, how reliant is that then? Like, what do you make of that? Like, what should the Fed actually do?
You know, it's hard because obviously they kind of have to support quote unquote the official data because that's, what it is. But it creates this, real dilemma. Again, I'll go back to that 3rd of July when I thought, June employment was going to, suck. It actually turned out it was great at the time. Now I was actually right, but it doesn't make difference. I lost money on my long treasury bets because the data that was published. So it's really, I think, hard for people. And it's almost on the one side, you have to make at least shorter term trading decisions on what you think the official data will be, because that seems to be what the Fed is reacting to. But in the longer term, I think you have to be deciding like what makes sense. When I look at the preponderance of data, of all the things that are available to me, that's what I think is going to impact us 3-6 months down the road. I think that's we're just seeing the start of this economic weakness. And I'll go back to one more point on this, and probably beating this horse to death, but it's I go back. They still make all these seasonal adjustments in the jobs. And traditionally, what they would do is add jobs in January, February, because that's when construction in the Northeast slowed, which was an important part of the economy. And then they take them away in the summer. And I've been arguing that our seasonal adjustment should look much different because so much of the construction occurs now in the Southeast, Southwest, that it actually picks up in the summer, in the wintertime, and slows down in the summer when it gets too hot to work. So this is at least the second year, if not third year in a row, we have all these great data, January, February, March, and then it looks awful in the summer. And I think a big part of that's because these seasonal adjustments are incorrect. So again, send out the raw data, let people play with that, let people make their own adjustments. And all these things that with how they do the seasonal adjustments, it takes 5 years, they use their set of rules, but creative out of the box thinking, I think would be a magnificent thing to get to.
Yeah, it almost sounds like a private institution at that point, that creative out of the box thinking. It seems very institutionalized, meaning government institutionalized the thinking, right? But they're supposed to be a private separate entity, and yet they can't figure that out.
Yeah, and it's it seems like they need a Doge-like kind of kick in, like, hey, let's just reimagine what this could be. If we were building this from scratch, if this was our job, or if we were trying to pitch to someone that you wanted to use our data, here's how we do it, and reinvent themselves. I think that would be just the best opportunity. On the other hand, again, I think it was discussed, if we get politicized and then we do start politicizing our data, then you run into the risk that no one trusts it even more, right? It's like sketchy data, but at least people trying hard and honestly is one thing. Sketchy data where people now make it China-like, where you can't trust anything, would be really depressing to me.
Absolutely. Peter, what would you do in 8 days' time if you were the Fed chair?
I would cut 50 basis points, I think. In fact, I would be tempted to say cut 75 and say, hey, we think we're behind. We've seen this jobs data. We're going to cut 75, but we're going to leave it on hold until at least early next year to see how it plays out. Because I think if they did something like that, it would help the long end perform better, right? So when I think about fighting the Fed, I don't think rate cuts are enough for where we are in the economy. What I'm looking to see is whether the Fed and Treasury Department, maybe combined, do something to really support the long end of the yield curve, right? Besson is a very, very smart person. He clearly saw that last September when the Fed cut rates, yields went up at the long end. I think we're going to see some sort of coordinated tactics between the Fed and the Treasury Department to keep long-term yields lower to help mortgage rates. In that case, I would not fight the Fed. Then I would buy, stocks hand over fist because I think they would do a great job. If I don't see that, I think you can fight the Fed for a little while.
No, it's I wouldn't want to be in Jerome Powell's shoes, because whatever he does, it's going to be the wrong decision anyway, quite honestly. Because like we talked about it briefly before hitting the record button, Peter, but I'm personally concerned about deflation. It really depends on the messaging, of course, but deflation meaning, well, if we signal 25, or if we cut 25 basis points, but we signal a few more cuts later this year, like, why would the consumer or anybody react now? And that's what we want. We want a reaction from the market, but it'll be delayed. What do you think on that?
Yeah, and again, I just think short-term rates are not really as effective as a tool as they once were, right? Most of us have mortgage rates, that have been locked in for, still 5 to 27 years. Corporations took advantage of ZIRP. So, it'll help some small companies. Credit cards aren't going to be affected. It's like maybe you're paying 19% instead of 20%. Like that's not, and that's this consumer, I think, who needs to be helped the most, is kind of that, lower income, struggling consumer. You're having student loan repayments start up again. I think the consumers, kind of tapped out. They're really struggling. So again, I just don't see how, moving it down helps. I don't see, 10 years, even if they get to 390, 380, it's not going to be this massive driver because so many of us have locked in low mortgage rates and things like that. So I don't think it helps. And I think as people lose jobs, as you maybe get some, that job losses start hitting, and there's so much uncertainty, there's so much, I think, concern. I think spending is going to remain slow. So yes, I think we can see some goods inflation tick up a little bit through tariffs. Some of that will feed into service, inflation. But as a whole, I think it's going to be capped by the slowing economy, by this job losses. And I don't think 50 to 100 bips, even in the next 3 months, stops that job loss. We need something to happen. So if the AI spending data centers slows down at all, I think we're in deep trouble. The flip side of that is I do think we're seeing some steps taken towards what we've been calling, production for security. So, whether you look at a deal like Intel or MP, the magnet maker, right? Those are things I think the government's trying to step in and really spur growth for the U.S. designing, developing, and producing things that we need for national security. I'd like to see deregulation. Deregulation would be a big part of that. So if we can really turn our attention to that, then maybe we get the growth we need. But if we don't turn our attention to that, I think we struggle in this economy. And I think we are going to see more and more slowing down. And this just this cuts isn't enough. I think the equity market's a little bit too jubilant over these cuts.
Yeah, the bad news is good news for the market, it seems like. S&P 500, I mentioned, is at record highs, loving the discussion on Fed cuts, especially jumbo cuts, or just Chris Waller, Fed Governor Christopher Waller, bringing up the term jumbo cuts, just fueled a massive rally. Are we, as you said, like the market, you said the market shouldn't be jubilant. It feels like they're almost naive and running to their own, what do you call it? You run into your own, I don't want to use the D word here, but they're running into their own, like, it's a
demise.
Yeah, sort of.
No, and right. No, and I think that's the risk. I saw it on Friday, right? We popped immediately after the number. Equities liked it. They faded throughout the day, and then they kind of started bouncing back. So, I think you probably have to get everyone fully on board with rate cuts are good, and maybe today's the day that happened. People read it over the weekend. People who don't trade for a living maybe decided to put out their allocations this morning. Oh, we're going to invest in some ETFs. We're going to do that. I think it fades into this week. I think the reality is going to hit that there's too many question marks, and cuts alone aren't enough. And we would need either some really aggressive, operation twist, something to really help the long end, and some sign that there's a bigger plan than just a few rate cuts for me to support equities up here.
No, exactly. I think the employment data will be a big tell on tomorrow, the revision to the employment data. And then inflation, I think we sort of expect to come in. What are the forecasts, actually? I have to admit, I haven't even looked. Are we staying on 3.1%? Let me just double check here. The 11th, we're looking at 2.9%. So, and then core inflation 3.1 to remain steady, which is interesting because you hinted at it as well, Peter. You do expect inflation to trickle in just a little bit. So you expect a higher inflation print later this week as well, then, Peter?
No, I think we're going to try to I think we're going to be supported around 2.5%. So it'll be hard to get below 2.5%, but I don't think we're going to stay above 3%. I think just the state of the economy doesn't bode for that, and it's taking time for these things to filter out. I will say on the truflation, it has been ticking up last time I checked, but again, it's probably, I think it's still 1.8%. So it's way lower than what the official readings are. I still think this owner's equivalent rent, we're making so many mistakes in our calculations that are just known mistakes. So why we do that, I don't know, because you look at Zillow rent, for example, and rents have been very stable. They're not showing inflation. So I think over time, we're going to trickle down to that 2.5 sort of level. Maybe then, tariff inflation will keep it propped up. But if the economy's slowing, I don't see us. I think the Fed is being overly vigilant about inflation and under vigilant about the jobs data.
Yeah. Peter, let's use the last 2 minutes to talk about the geopolitical influences, which the Fed seem to be completely ignore. They said, well, we're watching tariffs a little bit, or we have different scenarios for the tariffs playing out, but they're not really tying in anything else. Maybe peace in Russia-Ukraine crisis or anything else. Like, what is the market maybe not pricing in or ignoring, and what is the Fed ignoring, since we're coming from that angle?
I think there's two things that I'm watching closely, and we call it fairly loosely the American brand. Right? What has happened to the American brand? And so I want to see over time how U.S. corporate U.S. are doing overseas, right? About 40% of S&P 500 earnings come from foreign sales. And is there a reluctance to buy U.S. brands? this is a bit extreme, but at one time, right during the Soviet Union, Levi's represented freedom. But I think there's always been this aspirational quality, right? People want to be associated with the US. There's an aspiration to want these goods. Will that deteriorate over time with all that's going on? And I watch India very, very closely because I think the US has a lot of difficulty with a country like India. I think the US has two difficulties in particular with India. One is we are very, yes or no, you're for us or against us. So I think we struggle with someone who is just going to do what's right for India. And I also think there's a bit of a convergence where a lot of, some of the, I get a sense that a lot of the older US politicians still view India very much as an emerging market country, but India itself views itself as an emerging superpower. So I think that creates some friction. You watch, Modi was definitely around, Xi and Putin recently, right? Will China be able to work with India? Will we lose India? India to me is a linchpin, right? It's going to be one of the largest economies in the world over time, right? They're 1.1 billion people. They're growing. They are very tech savvy. They're doing a lot of things. You look at the AI data centers, how much can gravitate towards there. And so that to me is going to be a real linchpin. And if we don't treat with them well, we run a risk of, kind of these realignments of the world. And, we talk about the cards, who's holding what cards with us versus China. I think we underestimate two things. One, we're only about 15% of Chinese exports. So they have done a phenomenal job, if you're a Chinese business person or Chinese economy, to move away from us already. Two, they have a complete stranglehold on the processing and refining of rare earths and critical minerals. I hear so much talk about rare earths and critical minerals. I really don't pay that much attention to the rare earths and critical minerals themselves. We can get those. We have a lot of those here. What it is the processing and refining of them, which tends to be very dirty, very energy intensive, things that the West hasn't liked to do. China has a stranglehold on that. That's been clearly a big driver of these trade negotiations. We are not yet doing anywhere close enough to break that stranglehold. So I think we could see a US that over time loses some of their global relationships, feels pressure from that. And again, everyone's going to sign with the US for a deal, shake hands, because guess what? For most countries, it's the largest buyer of their goods. Having said that, the way things have behaved, there are probably a lot of people looking behind the scenes to figure out a way to be less reliant on the US over time. So I think, again, that's not going to happen overnight, but we may start seeing that data over the months and quarters ahead, where we have lost some of our competitive advantage. Again, I think we are currently trading tangible for intangible. We had so many intangible benefits that didn't show up necessarily as a dollar and cent that someone could easily calculate. I think we've given up some of those. I think that could start influencing us. And again, people are saying, oh, none of this happened. That's only going to happen over months and quarters, not weeks and months.
Maybe to summarize what we've just been discussing here, Peter, and I'm not asking for financial advice, maybe more of a generalization, but how should investors position until like the end of the year or the end of Q1 next year? Like, what do you think would be the right way to do it?
I like longer dated bonds right now. So in my income, I would probably be slightly overweight income relative to equity. So I'd be a little bit underweight equities, a little bit overweight income. Within the income, I like the longer dated part. I actually, in my personal account, I like a lot of muni closed-end funds. The long-dated muni market's relatively cheap right now. I think the cost of running that little leverage that the closed-end funds have will go down. I think you're going to see long-end yields remain stable this time. I think you're going to see spreads. So I'm very overweight that within my income. And then on the equity side, I've been fairly balanced. I'm reducing exposure, but I had a lot of China's exposure. I think it shocks people if you look. I think QQQ's up 25%, I want to say, in a year, and 13% year to date. The numbers for FXI are 55 and 26%. So it's been this massive outperformance. I still think you want some exposure to EM in your equity portfolio, and you want to shift a little bit away from what's going on. If we are getting these rate cuts and things are going to quiet down, in general, I would say I'd like the small caps. Problem for me right now with small caps is my belief that the tariffs and everything that's going on is much harder for a small cap company to deal with than a large cap. So again, I think I'm probably underweight the US relative to the rest of the world still.
No, fair enough. Awesome, Peter. Really appreciate your insights. We need to get you back later this year just to catch up on what the Fed is actually up to and how it is impacting the markets. Really appreciate your insights. Like, where can we send our audience to follow more of your work, Peter?
I am on Twitter at TFMKTS. So kind of a short form of TF Markets. And you can look at academysecurities.com website. We have the information published there.
Fantastic. Peter, really appreciate your time. Thank you so much for joining us, and really looking forward to all the data coming out this week, because it could really change the impact, the direction of the markets in a heartbeat. So really looking forward to that.
Thanks very much. And hopefully next time we're really poking a lot of time of figuring out how we want to deal with crypto, given the Genius Act, the change of regulations. I haven't figured out how I want to play that, but I do think that's becoming a more important strategy given what this administration is doing.
Absolutely. No, it's an interesting part, especially gold revaluation is another topic that we can discuss in the same breath here as well. I think that really fits the narrative with what you're mentioning as well. Fantastic. Peter, thank you so much. Really appreciate it. And everybody else, thank you so much for tuning in to Soar Financially. I'm on the road, by the way, in Colorado. I'm on my way to Beaver Creek, one of probably the world's largest mining investment conferences, and I appreciate you watching us. If you have any comments, if you have any feedback, put that down below. How are you positioned to end the year? And what do you expect the employment data to tell us? Should the Fed cut by 50 basis points, 75 basis points, or less? Should they hike? Shri Kumar the other day said maybe they should hike. So really curious what your thoughts are. Let us know, and we much appreciate your support. Thank you so much for tuning in. We'll be back with more. Take care out there.